It is Friday, January 30, 2026. And if you've been watching the markets, you've probably seen the headlines. But there is one earnings report that dropped early this morning from Irving, Texas, that I think we really need to pause on.
You are talking about ExxonMobil.
I am. And look, I know what you're probably thinking. Exxon, really, big oil.
Yeah.
Are we talking about gas prices? Because, usually when we talk about these legacy energy giants, the narrative is pretty stale.
It's been the same story for 100 years, yeah.
Right. It's either oil prices are up, they make money, or oil prices are down, they lose money. It's just this commodity roller coaster. But I've been reading through this stack of documents, the Q4 2025 earnings call, the whole transformation plan, analyst notes, and I'm seeing something really different here. I'm seeing a company that's basically claiming they're not really an oil company anymore.
Or at least not the way we've always understood them. It's a massive pivot. I mean, if you look at the numbers today, they are positioning themselves as a technology-led manufacturing company.
A manufacturing company.
Yeah, they're arguing that they've decoupled their fortunes from the daily price of a barrel of crude.
Okay, that is a bold claim. Decoupling from the one thing you sell, that sounds almost impossible. So our mission for this deep dive is to figure out if that's true or if it's just, good corporate marketing.
Right.
We're going to look at the Q4 numbers, sure, but I really want to dig into the how. We're talking AI logistics, proprietary plastic beads, and a total rewrite of their corporate DNA.
And we have to talk about the risks. Because pivoting a ship this size, I mean, we're talking about hundreds of billions of dollars in assets. It's incredibly dangerous. If they get this wrong, they don't just lose money.
They lose their relevance.
Exactly.
Okay, let's start with the philosophy shift. I kept seeing this phrase in the 2025 papers, the "and" equation. To me, that sounds a lot like a marketing slogan.
It does sound like a bumper sticker, doesn't it? But for them, it's actually the core operational strategy. The "and" equation is this: producing affordable energy and reducing emissions.
Okay.
And before you roll your eyes, think about the business implication. They aren't trying to pivot away from oil and gas to become a solar company. They're doubling down on the hydrocarbon molecule, but they're trying to make the process of getting it and using it cleaner and, more importantly, much, much more valuable.
So they're not having an identity crisis. They want to be a molecule management company. Is that the phrase?
That is the shift. The old model was volume. Just pump as much crude as you can. The new model is value. Manage that carbon molecule from the moment it leaves the ground until it's a finished product.
Whether that's fuel or like a plastic.
Or even captured carbon buried back underground.
Okay, so to do that, they had to reorganize. I read about these 3 hubs. It used to be this sprawling mess, but now it's just 3 pillars.
Correct. And you have to understand these 3 to get where the money is coming from. First, you have upstream.
That's the classic business, getting the stuff out of the ground.
Yep. Then you have product solutions. This is a mix of their old refining and chemical arms. Think of this as the manufacturing engine.
Okay, so making fuels, plastics, that kind of thing.
Exactly. And the third is low-carbon solutions. This is the new kid on the block. Carbon capture, hydrogen, lithium. It's their growth engine for the future.
I want to go back to upstream for a second. In the report today, they keep using this term advantaged assets. It feels like they're kind of throwing shade at their old oil fields. What makes an asset advantaged?
It's a polite way of saying cheap to run. In the past, big oil would drill anywhere. The Arctic, deep ocean, difficult political zones, whatever.
Right.
But advantaged assets means places with the absolute lowest cost of supply. By 2030, they're projecting 65% of their total production will come from just 3 places.
3 places.
The Permian Basin in Texas, Guyana, and LNG liquefied natural gas.
Wow. 65% from just 3 spots. That seems like a lot of eggs in very few baskets.
It is, but those baskets are incredibly efficient. The break-even cost is so low that even if oil crashes, they're still making money. They are prioritizing high-margin barrels, not just raw volume.
Okay, so that's the where. Let's talk about the how, because this is the part that really surprised me. I read that until pretty recently, ExxonMobil was basically 11 different companies operating under one logo.
It was a classic conglomerate mess. You had exploration, refining, chemicals, shipping, and they all operated in these deep silos. They had their own IT systems, their own HR, their own data.
And I'm guessing they didn't always play nice with each other?
Not always. I mean, imagine Department A sells a product to Department B internally, They'd argue over the transfer price just so their own division's bonus looked better.
So you spend all this energy fighting internally instead of fighting the competition.
Exactly. So this whole silo-busting initiative we saw in the plan was about creating one single integrated enterprise. And that allowed them to do something called design one, build many.
This applies to the oil rigs, right?
Exactly. Historically, an offshore platform was like a custom luxury mansion. Every single one was unique, designed from scratch. It took years and billions of dollars. Now they treat it like building a Toyota. They have a standardized design for the modules, they design it once, then they just stamp them out. This cuts execution time and costs by about 20%.
They turn construction into manufacturing.
They did, but you can't run a standardized global machine if everyone's using different software.
Yeah.
Which brings us to the tech stack.
Right, they implemented SAP S/4HANA. Now, I know that sounds like the most boring sentence ever spoken.
It is not exactly riveting dinner party conversation, no.
But the report makes a huge deal out of this. Why does a database matter so much to an oil company?
Because data is the lifeblood of AI. Everyone wants to talk about AI, but you can't use it if your data is trapped in 10 different ancient systems that can't talk to each other. By moving to a single digital thread, that SAP system, they unified the data for the entire global supply chain.
So they can see everything at once, from a well in Guyana to a train in Texas.
Everything. And because they can see it all, they can finally apply AI to their logistics to optimize shipping and rail in real time.
And that efficiency shows up in the structure, too. I saw a stat that they reduced the number of profit centers by 97%.
That is the silo busting in numbers.
Yeah.
97% fewer mini companies inside the big company. It just declutters decision-making massively.
Okay, so we have the theory. One big, efficient machine. Let's look at the scoreboard. Today, their earnings dropped. Did all this restructuring actually work?
It was a double beat.
Meaning?
They beat expectations on both the top and bottom lines. Non-GAAP earnings per share came in at $1.71, beating by 2 cents, and revenue was $82.31 billion, beating by over $600 million.
Okay, but I have to play devil's advocate. Is beating by 2 cents really that impressive? Maybe the analysts just set a low bar.
The context is what makes it so impressive. You have to remember, 2025 was not a great year for oil prices. Brent crude was down about 19% on average. In the old Exxon days, a 19% price drop would have cratered the earnings. They would have missed expectations badly.
But instead, they beat.
Right. And that, to me, is the proof of the decoupling theory. They made more money per barrel because their costs were lower. They aren't just riding the wave anymore. They built a better boat.
There's one detail in the earnings that I found kind of confusing, this earnings inversion. It looks like the part of the company that brings in the most money isn't the part that makes the most profit.
Yeah. This is a classic revenue versus earnings trap. Think of it like a grocery store versus a jewelry store.
Okay, I'm with you.
The energy products division, so selling gasoline, diesel, jet fuel, that's the grocery store, it brings in massive revenue, about 76% of their total, but the margins are razor thin.
So they sell a lot of gas, but don't keep much of each dollar.
Exactly. Now, look at the upstream division, the drilling. That's the jewelry store. It contributes about 56% of the actual profit, even though the revenue number is smaller. It's lower volume, but massive margins.
So the refining side keeps the cash flowing, but the drilling side is where the real wealth is generated.
Precisely. And that balance is key to their resilience. When oil prices drop, the refining side often does better because their input costs, crude oil, get cheaper. It's a natural hedge.
Okay, let's pivot to the technology that's driving that high-margin drilling. Because I usually think of bigger drills, but the report highlights something called lightweight proppant, which is, basically a tiny bead.
It is a very, very high-tech bead. So
help me out. How does a tiny bead generate hundreds of thousands of barrels of oil?
So when you frack, you pump water and sand down a well to crack the rock open. The sand, the proppant, is supposed to hold those cracks open so oil can flow out.
Okay, simple enough.
But the problem is gravity. Sand is heavy. It sinks to the bottom of the crack underground and just forms a pile.
So the top of the crack closes up again. You're leaving oil behind.
Exactly. You're only using half the fracture. So Exxon's chemical division, that cross-pollination we talked about, developed this proprietary lightweight proppant. It's a resin bead that's neutrally buoyant. It floats.
So it fills the entire crack, top to bottom.
Correct. It keeps the whole highway open. And the result is staggering. They're projecting a production increase of 200,000 barrels per day in 2026 from the Permian.
Without spending any more money on drilling.
Without spending a dime more on CapEx, it's essentially free oil just by changing the sand to a bead.
That is the power of that integrated model, I guess.
Yeah.
A pure drilling company wouldn't invent that.
They just wouldn't have the chemical engineering chops in-house.
Speaking of chemicals, this brings us to the part of the report that felt the most sci-fi to me. A product called Proxima. They're talking about replacing steel with plastic.
This is where that manufacturing company label really fits. Proxima is a new resin system they developed. It's a plastic that is lighter than steel, stronger than steel, and this is crucial, it doesn't corrode.
And they're using this for rebar in construction.
Rebar, yeah, think about bridges. Steel rebar rusts, concrete cracks, the whole thing crumbles. If you use this Proxima rebar, it doesn't rust, the infrastructure lasts longer. They're also targeting the auto industry.
So hold on. Instead of pumping oil, refining it to gas, and burning it in a car, they're taking the oil, turning it into a super strong resin, and building the frame of the car with it.
That's the idea. It's a much higher value use of that molecule, and it makes the car lighter, which makes it more efficient, whether it's gas or electric.
That is a fundamental shift from a fuel supplier to a materials supplier.
And that includes the EV market. You'd think EVs are the enemy of big oil, but Exxon is digging into lithium. They're extracting it from brine in Arkansas, and they're aiming to supply 1 million EVs by 2027.
Plus, they're making materials for the batteries themselves, right?
Specialized carbon materials for the anodes, yeah. So they don't care if the car runs on gas or electricity. They won't own the materials in the car either way.
It's a smart hedge. But let's look at the bank account again. We established they're making money. What are they doing with it all?
They are distributing it. They have what analysts call a fortress balance sheet. They've structured the company to break even at $55 a barrel for Brent crude.
And we are comfortably above that right now.
Right. So at 55, they pay the bills and the dividend. Anything above that is pure surplus. And they have committed to buying back $20 billion of their own shares.
Per year.
$20 billion. Every single year through 2026.
That is an enormous amount of buying pressure on your own stock.
It is. It reduces the share count, drives up the earnings per share. It's their way of telling shareholders, we have so much cash, we're just going to pay you.
But, and there's always a but, it can't be all smooth sailing. What's the bear case here? What keeps these executives up at night?
There are two big ones. One geopolitical, one existential. The geopolitical one is Venezuela.
The neighbor to their crown jewel asset in Guyana.
Exactly. Guyana is where the cheapest, best oil is. But Venezuela claims a huge chunk of that territory. And that border dispute is tense.
So if that turns into a real conflict, Exxon's best asset is suddenly in a war zone.
That is the nightmare scenario. Or even short of war, if Venezuela ever stabilizes and floods the market with its own crude, it could crash prices.
Which leads to the second risk. Energy abundance. Usually abundance is a good thing. Why is it a risk for them?
It's the irony of their own success. If Exxon's technology, like that lightweight proppant, is so good that everyone copies it, the world might get too good at extracting oil.
You flood the market.
Right. Technology-driven oversupply. If we get too efficient, we could push oil prices down to $50 a barrel and keep them there for a long time.
And at $50.
At 50, the fortress holds up, they survive, but the party ends. The $20 billion buybacks stop, the surplus cash vanishes. They might have innovated themselves right out of a profit margin.
The risk is that they are too good at their own job.
In a commodity market, efficiency can be a curse if everyone does it.
So we've covered a lot, the shift to molecule management, the tech overhaul, the earnings inversion, the risks. If you had to sum it up, how does Exxon look compared to, say, Chevron?
The consensus from the investment banks we reviewed is that Exxon is currently the clear winner when it comes to projected cash flow growth through 2030. Chevron's a great company, but they don't have that 1-2 punch of Guyana and the Permian that Exxon has locked down.
The advantaged assets.
And the structural cost savings. They've saved $15 billion since 2019, targeting 20. They've just decoupled from the commodity cycle more than anyone else.
Risk defined, portfolio protected. That was the closing line of their presentation.
It's a confident stance, isn't it?
It is. So here is the final thought I want to leave everyone with. We spend so much time putting companies in boxes. Tesla is tech, Ford is auto, Exxon is energy. But if ExxonMobil is successfully replacing steel with their own plastic and powering EVs with their own lithium, At what point does the label Big Oil just stop making sense?
It is already starting to feel a bit outdated.
Right. Are we looking at the future of Dow Chemical or DuPont rather than Standard Oil? If the molecule ends up in a car bumper, not a gas tank, is it still an energy company? Or is it a material science giant?
It really challenges the whole sector classification.
Something to think about the next time you drive past a station. Check your portfolio. You might own a massive tech manufacturing firm and not even know it. Thanks for listening to The Deep Dive.
Stay curious.